Here we are at the last part of our mini educational series called Trading the 61.8% retracement level, and we looked so far at trading the 61.8 when it comes after an impulsive move, after a five-way structure to the upside. We look at the 61.8 when it comes in terms of making the difference between a zigzag and a flat, like it was the case here. But how about using the 61.8 in terms of finding a possible top or a bottom? In our situation here in the Australian dollar, US dollar, the thing to do is to measure the first wave, the first move to the downside here, wave A. And this can be done by taking just a straight line from the top of the wave like this until the 61.8 retracement level. So this would be something like this, would be the length. Let's change the color for it so that we know that this is the measure move that we are looking for. Clone it, and this should be applied by the moment that the B wave ends right here. What does it mean? Well, first of all, because the 61.8 here failed to retrace into the B wave there, failed to retrace into the 61.8, tells us this is a zigzag. But in a zigzag, the C wave to follow, because we are looking at this C wave red, right? So the C wave to follow, it's a C wave that should go and even exceed the previous A wave with at least one pip. So the previous B wave should be completely retraced by this C wave. However, this should be a five-way structure. Well, alright, it is a five-way structure. What kind of a five-way structure? Well, it may be a first wave extension in the sense that we're looking at an impulsive move. It may be a terminal impulsive move, and then you are looking for falling wedges in our case, or it can be just a simple impulsive move like any other impulsive move. However, whenever you are looking for a five-way structure for this move to the downside, after the lows in the B waves are being broken, as you can see, the lows in the previous wave A here, if you project them on the right side, you had price testing them for 1, 2, 3 times, then breaking to the upside. And now if you project this area on the right side here, the same area that was proving to be here as support, okay? So the same area that here was proving to be a support, all of a sudden it is acting as resistance. So support, 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 broken then, and now it is acting as resistance. However, is this an area to still go short? Probably not. I wouldn't take this chance. What would this area be? Is an area not to be short and looking for reversal pattern. However, what would be the reversal pattern to look for? Well, first of all, you should look for the classical reversal patterns that should bode very well with a five-way structure. In our situation here, we should exclude the contracting triangle to act as a reversal pattern, in the sense that this is possible but not in an impulsive move. Second of all, we should look for reversal patterns like wedges, in this case falling wedges, or double bottoms, or inverse head and shoulders. Nothing really seems to be here as of this very moment. However, we do have some other clues on our side, and that will go, if you take a trend line from the highs in the B wave to the downside like this, and you see that this trend line here, if you make it, let's make it of a different color, let's make it red, and let's make it a bit bigger so that we can actually see what it means. This trend line, but the moment it has been broken here, even though price came and made a new low, it is still holding grounds. This is a small reversal pattern or bullish pattern in otherwise a bearish market. Therefore, what I will look here is for a break of such a trend line. As you can see, it is being broken, retested now, and this is a so-called falling wedge within a possible falling wedge, or a semi-bullish pattern. What I'm trying to say is here that whenever you see such a move, which is not quite a reversal pattern, but whenever you see such a move, this is no place to be short, or no place to be long either. Wait for the retracement level here to be, for the support area here to be broken, and then to engage into going long or to buy to buy call options, as this analysis show. Now, how to treat the 61.8? Well, the 61.8, as you can see, price is hesitating exactly on the C wave, exactly on the 61.8 retracement level when compared with the previous wave A. And this is no coincidence. And therefore, just like that, we have the difference between between a truncated zigzag with the C wave to be less than 61.8 or a normal zigzag that probably price already made. It remains to be seen future price action, but this is the last situation with showing you how the 61.8 retracement level should be treated. Thank you very much for being here. This was yet another mini educational series here on binaryoptions.net.au, and this is possible due to our sponsor here, Lioneye.